Happy Easter, everybody. This is Ken Long at Tortoise Capital with a review of the weekend trading report for April 15th, 2017. The market is in bullish normal conditions. On an annual basis, using weekly RSI 14, it's in the middle of neutral at 61. On a 10-day on a 10-day basis, it's deeply oversold, closing very weakly on Thursday. The score is 0 on the 10-day NDX. In the market mosaic, the market is weakened to yellow bullish at 5.26%. The slip of the 50 is yellow neutral at 0.3. ADX is a neutral non-trending 15.5. The risk index is the 30-period moving average of the VIX divided by the 10-period. 1.0 is the threshold between risk on and risk off. The current reading is 0.904, so we are deep into risk off. And you compare that score of 0.904 against the last 5,000 trading days, finding the average and the standard deviation, we can compute the risk Z at minus 1.18, getting into exceptional stretch territory. Now, this is a histogram of that indicator over the last 90 days. We're finally seeing the downside volatility that we were concerned about throughout this entire sideways nervous period, if you will. So this is a situation in which we do not favor swing trades. We're looking for increased opportunities for intraday trading on big range days that are directional, and it can be in either direction because we're in a bull market and yet volatility is rising. These are the blended monthly rebalancing holdings for this month. We will reevaluate on or about 1 May. These are the current leaders as of Thursday's close. ETF2 weakened in the theoretical asset allocation model to 70%. The model portfolio itself will be at 100% with stops in place. A quick look at the blended monthly rebalancing. We'll see in the ETF 13 that U.S. mids and smalls in Japan are all on cash signals. That is, their prices below their 4-month moving average. Leaders are Latin America, U.S. tech, emerging markets, and Australia. We're starting to see a few more in ETF 32 creep into the cash positions as well. Leaders are utilities, Latin America technology. ETF Max, these are the leaders based on about 1,000 ETFs in the large database. As always, I look for the things that are green across the board, and then on the 1 week performance are either exceptionally up, like Turkey and mortgage REITs, and things that are in the red, extremely down, because these are the extremes are the places where I expect continued big follow through in the week ahead, and so I like to program those for opportunity trades on the continuation or sharp reversal of momentum. Same idea for the S&P 500. Things that are come to my attention would be Seagate, FMC Corp, Micron, and Skyworks, with some remarkable swings of volatility. These large percentage moves create opportunities for swing trading that I favor. Hewlett Packard in the green. So you can see quite a large distinction here in the among the relative strength leaders, some real extreme performance differences, and that's what I like for my swing trades and even intraday trades too. In the market health check, these vertical blue lines are 10, 20, and 30 days worth of look back. This sine wave looking indicator is the slope of the 30-period regression line. This dotted line is the boundary between its positive and negative. The blue line is where it crossed into the negative. So when it crossed below here on this day, the slope of the 30 began to get negative. The current reading at minus 0.07 is not extremely down yet. It has to get below minus 0.22. But definitely we would prefer to be in long positions when it's positive, like it was during this entire run-up. So the slope of the 10 period is down. We've had 2 sell days in a row. It was threatened by a doji, then a hammer, and then 2 big directional days. So the slope of the 10 period is down, and it's outside of the Z2 into this danger area. And so that follow through suggests a potential downside of 228 based on political instability, is how I read that. And it puts this entire region of gains at risk. The slope of the 30 has rolled over too, as you can see. And so the price closed in the bottom half of both of those regression channels. Support at 293.5 cracked. So 228 is next on the target. If that fails, 226. And then back into this strong support at 223. You can see we're oversold on Williams percent R, and the PPO is organized to the downside, meaning that more of this could be in play. Now, the last time we had that sharp sell-off, there was a nice little rebound in here. We'll see if the failure of the North Korean missile test is going to give a sigh of relief and see a relief rally. If so, then the upside I would see is first return to the Bollinger Band mean, but it has to get above this 235.5, and then I place that upper target at 238 to remain in the channel. It's got to get above 238 to really resume the kind of strength that we saw in this leg. In ETF2, 3 of the 10 indexes are on cash positions, so that leaves us at 70-30 in the allocation model. And then 90-10 was last week, so we're getting measurably worse. EFA at 66 is better than the U.S. at 65. Inside the U.S., it's large caps, then mid caps, then tech, then small caps. The strongest 2 sectors, the Euro-Asia blend, and then emerging markets, the 2 weakest, Asia less Japan, and then the European 350. Inside the sector spiders, weakness remains in energy, consistently weak, and strength in utilities for the defensive play. World market model, starting with the U.S., real weakness in the Dow, and weakness balancing with a slightly above average performance. You can see the mixed bag we have here. Japan above average, Asia less Japan below average. Real strength in Malaysia, Taiwan, Korea, and most of Europe. Latin America is starting to get weaker. Emerging markets, Canada, Mexico, Brazil, very strong. Silver and corporate bonds responding well to the political uncertainty. Gold lagging a little bit, oil still beaten down. A real difference here between U.S. utilities and global utilities, and global healthcare versus U.S. healthcare, so a real mixed bag. ETF top 30, the ETF2 top 30. Japan total dividend. Things that are in the green and white are the ones that are recent additions to the the top list. So the UK, Alerian MLPs, short-term bonds, Taiwan, corporate bonds. Silver made a nice bounce here. It's green and yellow, rarely seen. Home builders and so forth. The ones that are green and strength and consistency are ones that have been there and at the top for a while, so there's some lingering strength still in India. The dividend index for the Dow, Switzerland, South Korea, and Malaysia. Dow 30, the same logic chain. Return to prominence here in Walmart. Used to be down at the bottom of the stack, has worked its way back up to the top. Sort of the life cycle and sector rotation here among the Dow. So I do like to keep an eye on the extremes that are all in the red right now with Exxon, Verizon, Disney. I'm looking for value plays and recovery from deep sell-offs, and then current strength is going to be green all across the board. American Express, Intel, Microsoft, Visa, Coke, United Health. Shifting to the daily, plenty of channeling and overreactions to choose from. some 5DDs and triple screens, 1551W, and then plenty of good auto framer candidates. You can see the lack of trendiness that has hit the market. Now this starting to uptick a little bit with bearish in charge with high volatility is again, I think, a reflection of that global political risk with a combination of who's crazier, Kim Jong-un or Donald Trump, and that's a toss-up. I check back in on that every day. The Dow 30 tactical summary, again, lots of channeling and overreactions, plenty of auto framer candidates that are better than 2 to 1, lots of good RSI 2 washout patterns, if you will. The frog quality numbers responding to the recent lack of volatility. The current volatility hasn't really caught up to that yet, so we're still seeing some good frog quality numbers. Lots to choose from in the ETFs as well, with XIV, Brazil, metals and mining among our favorite trading candidates. Strength here in silver, gold, treasuries, and volatility. That ought to tell you the recent trend of the markets. Auto framer statistics for you and the regression line fractals. The ones in the green are symbols that are the most ATRs below their long-term fair value in terms of the numbers of ATRs below, so more than 4 on these top 5. And then the ones in the red are the most advanced beyond their fair value in terms of how many ATRs beyond their fair value they look like. And so again, I like looking at these extremes in these two sections, the Dow and the ETF 100, to find my potential value and momentum plays. Daily squeezes are ones that had a large compression on the previous day compared to their previous ranges, and so this sets up the possibility of using a one-day pop trade frame where if it takes out either the high or the low of the of Thursday's price, that there's a good chance of getting a large one-day pop in the direction of price. So you can see the reward to risk ratios here that compares their maximum reasonable daily move, the range stat, divided by a reasonable range risk, and that gives you the reward to risk that's available. And I see Target, Euro Asia Blend, Google, real estate. So there's some real choices in there. The weakness in the S&P, see the slope is down, the polynomial is down, testing this previous swing low here. The slope of the 30 is now below average, down here around historically low points that have been turning points in the past. So if we get that crossover down in here, this is the kind of move that it responded with compared to its 200-day moving average of 10 or 15%. So when you get these crossovers that are more than one standard deviation from the 6-month average, it pays us to wait carefully for a change in market conditions. And so we're approaching one of those areas now. We're back into historical norms in terms of the slope of the 30. We're now below that average, still in the normal band, but we have pulled back from previously very high upward steeping the slope, the Trump factor. There's a zoom in on that 10-year look. Last thing I want to look at is the z-scores of the 3 regression slopes, the 10, the 30, and the 90. The 90 has rolled over and come back into the bounds of normal. The 30 has gone negative and started to stabilize and possibly roll up. The 10 has sold off. So this is a market that is ripe for a recovery here. It would not surprise me were that to happen. On the other hand, this is not a bad place to see one more sharp shock now that it's violated the bottom of the river. So again, short-term time horizon is indicated by all these pieces of the mosaic, and we'll be prepared to trade intraday primarily with looking for large one-day directional moves, but not trusting in the follow-through until we've seen some evidence that the bulls or the bears are starting to win longer term. And again, I think most of this is keyed towards geopolitical instability, which is considerable. So that's everything I wanted to cover today. This is Ken Long at Tortoise Capital. Keep your risk measured and your powder dry.